Good morning, man. If you're on the West Coast, you are here very early, and just got back from a long vacation myself, and I'm really glad that I set up the CPI live stream. But anyway, welcome to the special live stream with the release of the Consumer Price Index or CPI data for the month of May 2023. This is probably the most important CPI data that we need to read before the Federal Reserve makes an announcement tomorrow when they decide to either raise interest rates or pause at 5 to 5.25% Fed funds rate. And I've been talking about this date for a while now because the projections are very promising going into June and July. But anyway, the May CPI data is set to be released at 5:30 a.m. or 8:30 a.m. Eastern Standard Time, and we're getting a big update for the month of May in about 10 minutes. And I'm also going to be live streaming tomorrow when the Federal Reserve makes its decision to raise or pause interest rates. And I'm going to go over the June 2023 version of the summary of the economic projections. And we're going to find out the Fed's projections on the US GDP in 2023 and 2024, as well as the unemployment rate and the PCE inflation. So be sure to subscribe if you haven't done that already. So anyway, I'm going to show you guys this. Okay, so why does this matter so much to you, me, and the rest of the consumers? The CPI data will lead to how the Fed will make its decision on the interest rates. It's directly tied to the mortgage rates, right? And I want to buy real estate, and I have to say now is not the time for me to buy because the inventory level is still low in the Las Vegas area where I reside and in the United States as a whole. And I care about inflation so that I have a better idea about my purchasing power going into the second half of 2023 and the entire year of 2024. And I have several investments in the stock market I want to pay attention to based on the CPI data and how the Fed will raise interest rates in the foreseeable future. And take a look at the inflation report for April because it was better than expected, with 4.9% year over year and 0.1% month over month. The core CPI rose 5.5% year over year, and shelter had the smallest gain since November with 0.4%, but it's still rising 8.1% on an annual basis. The general consensus for today's CPI release is 4.1%, which is a significant drop, right? And the core CPI is forecast to decrease to 5.3% versus 5.5% in April. And I want you to take a look at this, the Cleveland Fed and Nowcast. Their CPI projection year over year is forecast to rise by 4.13% here in in May, and core CPI to rise 5.34%, and which is the most significant drop in inflation month over month. And it's projecting the CPI to rise 0.19% month over month and a 0.45% increase for the core CPI. And I also want you to look ahead and take a look at the June 2023 CPI projection. It is dropping from 4.13% here to 3.27%. And that is an insane decrease from just 1 month. And if the Fed decides to raise interest rates tomorrow, the June CPI with 3.27% will show that we're on track to hit the 2% target inflation rate. And I think that personally, it would be foolish and unnecessary for the Fed to, to continue raising interest rates when the CPI data shows 4% or lower in the summer months, right? And I'm really paying attention to shelter here, right? In the consumer price index summary, because shelter prices represent the largest share of the CPI, and it's considered the largest expense every consumer has to deal with on a monthly basis. The index for shelter right here, if you take a look at the third one from the bottom here, in the month of April, it was still the largest contributor to the CPI increase. And if you take a look down here, third line from the bottom, it took a nosedive from 0.8% in March and then 0.4% in April, but it still has uh, about an 8.1% year over year ending in April 2023. And the index increase contributes over 60% of the total CPI increase. And the other significant increase we saw was the index for energy, which increased by 0.6% month over month, but it's still down by 12.6% year over year. And don't be surprised if these energy indexes start to increase in the summer months, especially with Americans already starting to travel again for vacations, like I did, right? And also with Saudi Arabia, if you haven't heard, and other major oil producers, they're getting ready to cut their oil production by over 1.15 million barrels per day from July until the end of 2023. And there's a possibility that our energy commodities could spike between June or maybe May and September when people travel the most. So don't be surprised if the gas prices start to go up too. Another major increase I saw was used cars and trucks by a whopping 4.4% just in April 2023. And new vehicles actually decreased just by 0.2% because typically you'll see new vehicles increase while used vehicles decrease in inflation. And the major catalyst is pretty much gone now. With the debt ceiling suspended for the next 2 years, I am looking forward to the earnings season towards the end of June and July. And I think we're going to see some major moves in the stock market when we get to Q2 and Q3 earnings of 2023. And I want you to take a look at this here, right? The S&P 500 chart. And if you haven't been paying attention to the stock market, the S&P 500 is making the biggest gain since the beginning of 2023. And at the time I'm recording this video, it's made over 13% in return. And in full disclosure, I have the S&P 500 index fund with my HSA or health savings account, Roth IRA, 401k, or TSP, right? And the NASDAQ, take a look at this. This is insane. It has made 29% in return since the beginning of 2023. So if you have QQQ or something equivalent to the NASDAQ 100 ETF, congratulations, because you've made some pretty good returns so far in 2023. The NASDAQ tracks stocks like Microsoft, Apple, Amazon, Nvidia, Meta, Google, Tesla, and many other tech stocks, right? And Nvidia has been the story in 2023 with the potential growth of AI in its future. So, and this is not in any form of financial advice. And I'm doing what makes sense for my financial independence journey. And I want you to do what makes sense for your fire journey so that you can retire early or do whatever it is that you want to do when you achieve financial independence. And my age and risk tolerance are not the same as yours, right? And my investment vehicles work for me and my family because of our income, the types of jobs that we do, and where we are on our financial independence journey. And what you can do today is to take some time to review your investment accounts from your 401k, Roth IRA, HSA, and taxable investment accounts and find out if it's been working out for you or if it's not been working out for you. But anyway, this CPI data will be very important for us consumers and the Federal Reserve, who's watching this right now, to see if inflation is on its way to the 2% target rate. Not to mention the Fed possibly raising interest rates tomorrow. And I think we're pretty much there with this trajectory, right? And I would be shocked if the Fed decided to raise interest rates anyway. And we could also see a surprise today that CPI or core CPI doesn't meet expectations. And what happens to the stock market if CPI comes in higher than expected with something like 4.4% or 4.5%? And I think the market cares more about the core CPI than the CPI. If it comes in higher than, let's say, 5.5% core CPI, then I wouldn't be surprised if the market reacts negatively. But anyway, with a few seconds left, let me pull up the banner here. What's up, Pilot Pete from Fort Lauderdale? I just got back from Florida too. Had a great time there. All right, in about 10 seconds, it should be coming up here. So let me go ahead and do what I do. Not there yet. There we go. All right, CPI for all items increased by 0.1% in May. Shelter and used cars and trucks up. So right now, everybody's trying to load up the the website right now. Let me go and pull it up. So come on, baby. It's kind of a little bit slow when everybody's trying to log in at the same time. So it's really, um, it's going to take a minute here. Come on, baby. Let me load. All right, so what I can read from the summary. Okay, so yeah, everybody's kind of trying to log in at the same time, so it's dropping connections. That's pretty funny. All right, so in May, the consumer price index for all urban consumers increased 0.1% seasonally adjusted and rose 4.0% over the last 12 months, not seasonally adjusted. So it is a beat, 4.0%. It was estimated at 4.2%, and the index for all items less food and energy increased 0.4% in May, up 5.3%. So core CPI is meet. For the headline CPI is beat. All right. So let me see if the website is working out. All right, it is working out. So let me take a look here. So this is more of the HDMI version, but you can go to the U.S. Bureau of Labor Statistics. Just go to bls.gov, and it tells you here's the website. Go to news release. Anyway, all right. So the CPI for all consumer, I already read that. So index for shelter was the largest contributor, followed by an increase in the index for used cars and trucks again. Okay, so the food index increased 0.2% in May after being unchanged in the previous 2 months. The index for food at home rose 0.1% over the month, while the index for food away from home rose 0.5%. Okay, that's interesting. The energy index, in contrast, it declined 3.6% in May as the major energy component indexes fell. Okay, so the oil prices have been dropping too. So that's really interesting to see how this is gonna work out. Okay, so let me take a look at the more of the food. This is May. 0.1, 0.2, 0.1, 0.5. So the energy overall has gone down by 0.3, negative 3.6. Energy commodities down negative 5.6. Gasoline negative 5.6. Fuel oil negative 5.6. Actually, that one is 7.7. Energy services, that's negative 1.4. Utilities been coming down, so year over year, that's about negative 11% here. Let's see. Yeah, so this is really interesting. The new vehicles, right? So if you watched my live stream last month, the new vehicles actually came down by negative 0.2%. It's been steadily climbing, like 0.5, 0.6, 0.2, 0.2, right? And it's year over year is 4.7, but now it's come down another negative 0.1%. And if you look at the used cars and trucks, take a look at this. Look at 4.4 and 4.4. But before that, that was negative 2, negative 2, negative 1.9, negative 2.8, negative 0.9, and then now it's positive 4.4 or 4.4, and the year over year is negative 4.2. So what I'm wondering is that these months, right? So I'm thinking, this is just my guess, is that people realize how expensive it is to get a car loan. Even a new car loan right now, the average is about 750 bucks a month. And buying a used car is much more attractive now because you could get a lower car loan rate, the loan rate with the maybe 72 months, 60 months, right? And I'm going to hide the banner here so it's not confusing anybody. But now all of a sudden people are kind of jumping onto the used cars and trucks, and I think the demand is there. And now the new cars are kind of like, you know what? People are not really buying them right now, which is not surprising because of the high interest rates, right? And people hopefully people start to realize how expensive new cars are, because they immediately lose value as soon as they leave the lot. So like you lose like 15% in the in car value as soon as you drive it off if you buy a brand new car. Like someone that I know bought a BMW and lost like $20,000 in value soon, like a month after that. So he made like a $20,000 deposit to buy a BMW. So basically, he just lost $20,000. That's just insane to me. But buying a car is just so expensive right now. It always has been. Now I'm gonna make a video about that. And I have made videos about that in the past, about how how to get out of the car payment cycle, which is over and over and over again. So just I haven't had a car payment in a while, and I'm really really glad that I got out of that, because I used to just trade in my vehicle just over and over and over again. Let me know in the comment section down below if you feel that way too. But when you trade it in, you know how that the car is just valued so much less than what you pay for. So I remember I had a 2002 Saturn SL2 that I bought for $15,000, and when I traded in, it was valued at like $4,000, and I'm like, that's it. Dang, man. It's just crazy. The car buying business, some of the dealerships you got to watch out for too. But anyway, enough of the cars. I could talk about that all day, about new vehicles and used vehicles. All right, for the CPI for the apparel. So apparel, clothes, people have been consistently buying clothes. Medical care commodities have been going up. It's going up a lot more than it used to. Shelter, it went back up to 0.6% month over month, right here, third line from the bottom. So, like I said, the shelter is it contributes 60% of the overall CPI. So it's a big thing, but it is at 8.0% year over year. Take a look at transportation services. It is still going back up to 0.8%. So that is still getting pricey, right? And medical care services year over year, it's showing some deflationary indication of negative 0.1%. So speaking of deflation, let's take a look at some of the things that are showing deflationary, right? Energy at negative 11.7%. Energy commodities at negative 20.4%, gasoline negative 19.7%, and fuel oil at negative 37%. Utility gas service negative 11%, and then used cars and trucks negative 4.2%, which is very typical. But like I said, if you're just joining me on live, I appreciate you joining, but this is still concerning about the 4.4 and 4.4. So that is something that I need to dig a little more on. Usually comes out later on for more of a, well, actually, you know what? Maybe I can pull up I can probably pull up the PDF here. The website, if you're just joining me, the website actually crashed. That was hilarious. Like the CPI, the government website crashed. I'm not surprised. Uh, I'd be surprised if anything works smoothly with the government. All right, so let me take a look at the transportation here. So if you go to the website, the bls.gov, and you click on PDF instead of HTML, it gives you the whole breakdown. Okay. So you know what, while we're looking at this, I do want to listen to Bloomberg and see what they're saying here. Let's see. Okay. Stop sharing. Present. Share screen. Bloomberg. I need to unmute this, huh? There you go.
and Tom Keene, John Farrell preparing for our next eventful hour. Michael McKee with us and Abby Joseph Cohen to join us here after a careful study of the CPI report. That must mean we need to go to Michael McKee on the shock and awe of the moment.
Well, I need the BLS to go to its computer and start downloading the numbers. We're a little bit slow this morning, which sometimes happens when everybody starts hitting the numbers. Here we go.
That
CPI
was happening.
comes in up 1/10, the headline, which is exactly what was forecast, down from 4/10 last month. And the core comes in at 4/10, exactly as forecast, which puts the year over year, and this is a base effect, at 4% for the headline, and the core at 5.3%, which is down from last month's 5.5, but a tick higher than the 5.2% that had been forecast. So in other words, this is a kind of status quo report. Is almost exactly as forecast. And so what you're looking at is a Fed that doesn't have any reason to change whatever view it has decided on, if it has decided on as of today.
Let you jump into the data here, Mike. The status quo is a lift to the equity markets. You see that on Bloomberg at television. On radio, NASDAQ up 0.6%, up 0.3% earlier. Maybe call it the Kospi of the American system right now. The VIX was 15. The VIX comes into a more optimistic 14.59. Lisa, the move in yields is tangible, lower yields right now.
Which is interesting because if you look at core year over year, it actually surprised to the upside. People are looking past that. They're looking at the headline. And to me, that's interesting because a lot of people are saying the core would be more important. People want to see some sort of deceleration, and they're willing to take it even if it's not as much.
I like the status quo, the mix here that we see among 4, 5, 6 data. And dare I say they're going to go, we need to look at PPI tomorrow?
No, actually, I think that this basically, what the market is saying, at least the initial reaction, which obviously can change in a heartbeat, basically is saying that this takes off the need for off the table, the need for the Fed to come out and surprise markets with a rate hike. They are okay holding because there wasn't some sort of significant upside surprise.
I'm going to go to a global growth statement off this. This is all micro moves. We don't want to oversell this right now, but the answer is equities lift nicely. The S&P well over 4,400 on futures. Abby Joseph Cohen just fell off her chair on 4,400, predicting another bull market. We'll get to her in a moment. Professor Cohen, I should say. But what?
Northwest Stacker, hello from Seattle. What's up? What's up from Vegas?
68.92 off the 66 print that we saw the other day. Mike McKee, give us further data here on the status quo of 4,000 lines of BLS report.
Well, the big news comes in energy. No surprise there. Gasoline prices down 5.6%. And we should see if prices in the markets hold that go into July to June as well. Energy services down 1.4% overall. Apparel prices down 0.2. Used cars and trucks up 4.4%. We're waiting. There's been a drop on the wholesale level, been waiting for that to get into the CPI. Not there yet. And some analysts have been saying, watch the numbers in July. When we get the June report, it'll go down in June, and that'll put some extra pressure on it.
Abby from Queens says, what's rents doing?
Well, rent of primary residences up 0.5. I'm sorry, that's a tick down from the 0.6 of a prior month. Same, though, as in March. So not a major drop yet, but it does show some movement. Also 0.5 for owner's equivalent rent. You guys were talking earlier about airfares and how they're hanging in there. Wrong. Airfares down 2.6%, a fairly large drop, down 3% after being down 2.6% last month. So airfares seem to have topped out, which is one of the reasons that we're seeing some downward pressure.
10 seconds to get to Professor Cohen. Does this change your questioning to Jerome Powell tomorrow?
No, I think it still leaves the question open. If they don't move tomorrow and give us a hawkish hint, then what is it that's going to move you to raise in July? Does it have to be a turnaround in inflation? Because right now we're seeing inflation sort of on the path that they have laid out.
Very good. Michael McKee with us. And of course, this important work tomorrow as the Federal Reserve reports. We'll have our special coverage tomorrow afternoon. It is a joy after
Yeah, all right. So that's good enough from Bloomberg. So I was kind of looking for the used cars and trucks, and I'm gonna pull this up here on the data because I was curious about it, and I am still kind of trying to break down. If you can't see it, I know there are a lot of letters. I just found this out the other day. On YouTube mobile device or iPad device, you can actually pinch and zoom in on the screen on where I'm looking at. So I'll try to scroll down as slow as I can, but you can actually pinch and zoom in like this on your YouTube, and it just you can zoom in on the screen, which is really cool. I didn't even know about that until recently. So good job, YouTube, on that. So he mentioned about the airlines, right? So um, been traveling the last 3 weeks, and I can the airline fares. I know this is so like very general information. Hold on, wrong screen. There we go. So airline fares have come down negative 2.6%, but it really depends on the destination. So if you're still flying out to like Orlando, or going to Tampa or going to Vegas, those airfares are still up. So it's kind of like, uh, it just really depends. But overall, though, overall airline fares are dropping by negative 2.6%, which was really surprising to read too. So this is a lot of pages to go through. But one more thing that was interesting here was the vehicles, car and truck rental went down by negative 3.2%. Um, Rent has gone up a little bit, but let me know. Let me know in the comment section down below where you guys are from, like how it is in the rental market, the housing market in your area. I know everybody. I'm going to talk about the real estate a little bit tomorrow, about my real estate buying strategy here, but it's just quite interesting about the real estate. A lot of people back, like last year, they were like, oh yeah, this is going to be a housing market crash over the US, but it turned out it's more like city by city, right? And I know Seattle, I believe that they're like number one in the home prices that are dropping the fastest. And then number two, I believe, was San Francisco. I need to look at the ref and data again. I don't want to give you false information, but I do remember seeing Seattle and San Francisco being on the top list. So that would be really interesting to see. So food still dropping, and then there was something else I wanted to see. Yeah, used cars. That was the other thing that I wanted to see. The clothes, they're still going up. Come on. You know what? Let me see if I can search for it. That won't work. Okay. All right. So So anyway, I'm gonna look into it more, and I'm gonna talk about it in tomorrow's live stream. Oh, there it is. Okay, new cars. I just happened to scroll through. Okay, used cars 4.4 here. Okay, so I want to do some math on the index. I don't want to nerd out too much on the live stream, or I'm going to be live streaming for hours. But anyway, if you take a look at page 24, and it tells you it's up 4.4%, and I need to look at the supply index too, and the new cars and new trucks. But anyway, if you're just joining me, what this means is basically the new cars are actually, the prices are coming down, but the used cars and trucks went up by 4.4% month over month. So from April to May, it increased by 4.4%. That is the general price increase. Okay. So it really depends on the area too, but it's just the general number. So anyway, really interesting. I'm going to look at it later on, and I'm going to try to, I'm definitely going to live stream tomorrow, but there are some things that I do want to give you an update. So after the CPI, I am going to talk to you about one second, the HSA update and the TSP. TSP was just the thrift savings plan, and I'm going to show you that in a second here. Okay. Make sure that it's working. Should be working. Okay. Let me show. There's some major updates with the HSA, and I forgot to talk about that because I was on a vacation. But anyway, all right, let me make sure. All right, cool. And yeah, good question from Facebook. Yeah, I'm gonna turn this into a clip too to make sure that people can watch it. But just real quick, the stock market reaction is pretty much flat right now. S&P 500 is up by 10 points, 0.25%. Dow Jones Industrial is up 48, and NASDAQ is at 81. So I'm going to talk about the not inflation, but the stock market a little bit. Give me 1 second. Let me set this up. Okay. Let me know where you guys are from in the comment section. Love to know where you guys are coming from. All right, cool. Set up and ready, set. If you're on the financial independence journey, there's breaking news about the health savings account or HSA for 2024. The annual contribution limit. You know what? It didn't even pull up. There we go. All right. The annual contribution limit for health savings account or HSA starting on January 1st, 2024 is rising from $3,850 to $4,150 for individual plans, which is about an 8% increase based on inflation. And if you're on a family plan, the contribution limit is rising from $7,750 to $8,300. The catch-up contribution limit for HSA, if you're over the age of 55, will remain at $1,000 each, all right? So if you're on a family plan and you and your spouse are both 55 years old, your maximum HSA contribution limit will be increased to $10,300. This is a historical HSA inflation adjustment, and it will make a significant impact on my early retirement strategy. And an HSA is possibly the most overlooked investment vehicle for Americans. And I actually prioritize my HSA investment over the Roth IRA because of the triple tax advantages, which I'll briefly go over in a little bit. And I started investing in my HSA in 2022 because I wasn't eligible for the high deductible health plan or HDHP until 2022. So let me show you my HSA investment calculator, which you can download for absolutely free by visiting firesightchat.com/resources. In 2022, I was 36 years old, and my wife and I contributed a total of $7,300 to our HSA because that was the maximum contribution limit for the year 2022. And we made a total of 4% in total return due to the bear market right here, okay? And I only invest in the Vanguard S&P 500 index fund, ticker symbol VFIAX, and I just continue to dollar cost average my HSA into my investment every 2 weeks. In 2023, we are contributing collectively $7,750 to our HSA, which is the maximum HSA contribution limit for the family plan. So far, we've made about 11% in year-to-date returns. By the end of 2023, we should have anywhere between $15,000 and $17,000, depending on the performances of the S&P 500. In 2024, the maximum contribution limit will be increased to $8,300 for the family plan, right? With the 8% average annual return, we're looking to have over $27,000 by the end of 2024. When I put a 10% average annual return for last year's videos, people got really mad because we were in the bear market. And now I put 8% return because people are like, why are you only putting 8%? And I really you know, at the end, I just can't please everyone. But anyway, with HSA, you actually don't have to be employed to make the contributions. So we're going to continue to contribute to our HSA as long as we have the HDHP or high deductible health plan. My wife and I will turn 55 years old in the same year in 2041. So, which I have highlighted right here in the cell. So our contribution limit should significantly increase by then. So by the time we're 50 years old, we should have $250,000 in our HSA. And by the time we're 55 years old, we're going to have over $430,000. And when we turn 65 years old, we're going to have over $1 million invested just in the HSA. And I'm going to explain how HSA works, okay? Because we're treating it like a combination of a traditional IRA and a Roth IRA. And if you go to my YouTube channel and click on the HSA playlist, you're going to see a list of videos that tell you how to invest in the HSA. So I'm going to show you this. Just a quick tutorial. It won't take long, I promise you. So anyway, with an HSA, the contributions you make are in pre-tax dollars, which means you don't pay federal or state income taxes except for California and New Jersey. So if you live in California and New Jersey, I'm sorry, you still got to pay taxes on the HSA contribution, but just the state income tax. And you don't pay Social Security and Medicare taxes or FICA for the HSA contributions. And you can actually invest what you contribute to the HSA to index funds, ETFs, bonds, individual stocks, or target date retirement funds. The capital gains and dividends that are paid by these investments are also tax-free, which means I don't pay any taxes on the earnings and interest that grow inside my HSA. And at any time, you can take your contributions, earnings, and interest out of the HSA penalty-free and tax-free as long as you use it for qualified medical expenses in accordance with the IRS. And assuming that you are eligible to get the HSA with your employer under the high deductible health plan or HDHP, your HSA contributions will be automatically deducted from your paychecks. And this is your pre-tax money going straight to the HSA without federal, state, or FICA taxes. What's also great about the HSA is that some employers can give you a match like the 401k. My employer gives me a match to the HSA every single year. And you should ask your employer if they provide a match to your HSA. But here's the catch. Unlike the 401k, the employer match does count towards your contribution. So in 2023, the contribution limit for single individuals is $3,850. And the contribution limit for a family plan is $7,750. If your employer gives you $500 every year under the individual plan, then you're only allowed to contribute up to $3,350. But with the 401k, the employer match does not count towards the personal contribution. So keep that in mind. And when you put money in the HSA, it automatically gets deposited in the HSA checking account. You're going to get an HSA debit card in the mail when you first open the account. The second portion of your HSA will have an investment brokerage account. And you can move cash out of the checking account and put it in investments and vice versa. But keep in mind that some HSA brokers have restrictions, like keeping a certain amount of cash inside a money market account before you start investing. My HSA has a requirement to keep $2,000 in cash and then invest the rest. So make sure you read all the fine print about your HSA. And lastly, you have the option to move money out of HSA and put it in your checking account at any time, but only if you use it for qualified medical expenses. You can't just use it for whatever you want, or you're going to be penalized for 20% plus federal and state income taxes on top of the penalty. After you turn 65 years old, then you can spend your HSA on non-qualified medical expenses, but you'll just have to pay ordinary income tax. And let me just quickly show you the simple comparison chart between HSA and Roth IRA. And I showed this in the previous live stream, but I'm going to go over it again anyway, quickly. The HSA allows you to make pre-tax contributions, which means it will lower your taxable income every year and potentially save hundreds, if not thousands, in federal and state income taxes every single year, depending on your marginal tax rate and the state you reside. Your employer could give you an employer match to the HSA or just a straight up contribution based on the provider you have. But keep in mind that unlike the Roth IRA, you don't need to have an earned income to contribute to your HSA. You just need to be enrolled in the HDHP. And when you start investing, your HSA will grow tax-free inside your HSA and reimburse yourself at any time as long as you have the medical receipts to provide proof of medical expenses. After age 65, you can use the HSA for anything and not owe any penalties, but you will owe income taxes on the non-medical distributions. And for the Roth IRA, the contributions have to be in after-tax dollars from your checking account. So the IRS assumes that you already pay taxes on the contributions you made because your W-2 paychecks have federal, state, and FICA taxes deducted, right? With the Roth IRA, you don't get an employer match or employer contribution, but the investments inside the Roth IRA will grow tax-free, just like the HSA. The difference is that I can make the withdrawal on my contributions at any time without justifying that they're for medical expenses because I already paid taxes on my Roth IRA contributions. So the government can't tax me twice. And when I turn 59 and a half, I can withdraw the earnings and interest that accrued inside the Roth IRA, both penalty and tax-free. So don't overlook the tax benefits of the HSA. Just imagine this for a second. You can treat your HSA like a combination of a traditional IRA and a Roth IRA. The primary purpose of the HSA is to pay for your medical expenses, right? But what people like me do on the FIRE journey is actually treat the HSA like a separate investment account. And I get to contribute to my HSA in pre-tax dollars, grow my HSA investment tax-free, and withdraw my HSA investments tax-free if they're used for medical expenses. And what's awesome about the HSA is that I can just invest all of my HSA contributions and use my cash to pay for my medical expenses. And I'm very organized with the HSA because anytime I make a withdrawal from my HSA, I need to have a receipt to prove that it was a medical expense. So for example, let's say I went to a CVS pharmacy and I got a CVS pharmacy receipt in the amount of $100 from 2022 for my medicine. And I paid $100 out of my own pocket and I never touched my HSA because I didn't use my HSA to pay for my contact lenses. And as long as I keep this receipt, I can withdraw $100 for my HSA at any time, tax-free and penalty-free. And I can reimburse myself that $100 this year, next year, or 20 years from now. And it doesn't matter when I do it as long as I have the receipt. So imagine spending $3,000 this year on medical expenses and I get to reimburse myself $3,000 tax-free and penalty-free when I retire early in 8 or 10 years. And I encourage you to download my financial independence resources by visiting firesightchat.com/resources or schedule a complimentary coaching session by visiting firesightchat.com/coaching. Speaking of the coaching, I know it's been getting full with the appointment slots, and I do apologize for that. And as soon as the June appointment came out, it just they just instantly filled up. And I know that sounds like a humble brag. It kind of is. Really appreciate everyone reaching out. Trying to list as many appointments as possible, but right now I'm just really completely maxed out right now. And I believe the July one just came out. Just one, I can't remember the date, but I'm gonna take a look and see if I can make more appointment slots for July. So stay tuned for that. Okay, let's see. So I do want to go over TSP real quick. TSP, which is the same, it's equivalent to a 401k. And I do have a new tool that you can download for absolutely free by visiting firesightchat.com/resources. Let me see. I want to make sure that I pull up the tool, and I want to go over the stock market just real quick because it has been an insane bull market for the last 6 months. Okay. Let me know in the comment section down below if you're a federal employee or if you're a veteran who has a TSP. This is going to be a great tool for you to use. Let me see 1 second here. Should work. Okay. All right. Here we go. So I want to focus on the TSP or thrift savings plan. I know how to say it. So I want to focus on the TSP or thrift savings plan for this segment of this live stream. And do you guys remember how bearish people were at the beginning of 2023 that the stocks were going to continue to crash like in 2022? And I watched so much TV, like on CNBC. A lot of the experts were saying that the 2023 is going to be another horrible year. We're going to be seeing another dot-com bubble crash, right? I got so much flack in the comment section when I posted that video about my $1.9 million TSP investment strategy. And people were saying how dumb I was and that the market would continue to crash going into 2023. And a lot of people decided to move their TSP into G Fund in 2022. And if your TSP hasn't grown in 2023, it probably means that your money is still sitting in G Fund or you're just not contributing enough to the TSP. But anyway, I want to show you the best performing TSP funds so far in June 2023. If I click this, did not click that correctly. Okay. So the C Fund right now is the best performing mutual fund in the TSP with almost a 14% return year to date, right? And you can actually download this spreadsheet. And it's going to be named TSP Funds for absolutely free by visiting firesightchat.com/resources. And you have to keep track of the prices by logging into the TSP because TSP does a terrible job of updating us on how the funds are performing on a daily basis. They only update the TSP year-to-date charts on the last day of each month. But anyway, what this spreadsheet tells me is that since January 1st, 2023, if you have $1,000 invested in the C Fund, you've made $140 in interest so far from that $1,000 you invested in January. The C Fund mirrors the performances of the S&P 500 index fund. But if you're actively contributing to your TSP, your total return would be lower, like 9% or 10%, because you're dollar cost averaging your TSP investments every 2 weeks or on the 1st and the 15th, right? So the shares you're buying actually fluctuate on a biweekly basis or how frequently you get paid. Anyway, so you have to go to this TSP share price history to get the latest share prices for each fund. And I'm going to deselect the life cycle funds and I'm just going to choose the individual funds. So using the spreadsheets I showed you earlier, you can put today's share price in C, S, I, G, and F funds. So the share price for C fund as of yesterday, June 12th, ended with $67.06 and some change, right? And I just put that share price in this cell here, and it tells you how much your C fund has grown since January 1st, 2023. But the most accurate chart will be in your quarterly TSP statement because your allocation and how much you buy into your funds are different from all of us, right? And this is just a good tool to know how well or how bad the market is performing for the year. So, and let's just focus on the C fund for a minute. And here, take a look at the S&P 500 stocks with the best performing stocks so far. Okay, so right now, we've been talking about Nvidia for this entire year with the AI, and it's made over 170% return so far, which is insane. And the second best performing stock is Meta with over 125% return. AMD or Tesla with over 102%, and AMD with almost 100% return. And there's also Royal Caribbean. I know the Carnivals. All the cruises are making a big comeback. You look at GE with 62%, Salesforce, let's see, Broadcom, Chipotle, Amazon, Align Technology, and all that. They've all made some really good returns so far in 2023. Tesla has been having a crazy uptrend with 12 or now it's like 13 positive trading days in a row, but only half of the S&P 500 stocks are in the green so far in 2023. But the other half, I'm going to show you here, the other half of S&P 500 are actually in the red, right? You can scroll all the way down and it tells you the worst performing stock, which would be Advanced Auto Parts with negative 54, almost negative 55% return, followed by Dish Network, Dollar General, Schwab, AES, Moderna, and other stocks. And as you can see here, and in full disclosure, I do own some individual stocks out of these S&P 500 stocks. This is not financial advice. Don't invest in them just because I do. And I have Meta that I bought heavily last year when the share prices dropped. Take a look at here. Let me, if I can. Okay, here we go. So yeah, so I bought Meta heavily last year when the share price dropped below $100, and it's made some really good returns this year. And I also have Tesla, which I continue to buy when the stock price tanked last year to about $105 and $115 per share. Now it's sitting at about $250 per share. And I'm also seeing a tremendous upside for Google with YouTube in particular. And ever since the NFL decided to dump AT&T's DirecTV and sign with Google to have the NFL Sunday Ticket exclusively with YouTube TV, which can be streamed anywhere in the US as long as you have the YouTube TV app. And cable and satellite TVs are pretty much dead at this point when you have all the streaming services like YouTube TV, Disney Plus, Netflix, and Apple TV, right? And I think Google stock alone will go up tremendously in Q3 and Q4 in 2023 when football fans dump DirecTV and just switch to YouTube TV so they can watch their favorite football teams, right? And I've been bullish on Google for a while now, at least since 2021, when the stock price dropped to the low 80s, right? No, the low 80s, that was in 2022. And I became even more bullish when YouTube TV got the rights to the NFL Sunday Ticket, because I know there are about 120 million US households who watch football every season. And I'm a Raiders season ticket holder here in Las Vegas. And I know a lot of people who travel to Vegas every year to watch their team play. If 50 million US households purchase the NFL Sunday Ticket for $350 each, that alone is $17.5 billion in revenue just for the NFL Sunday Ticket. That's not even including the YouTube TV subscribers who pay the base price of $70 a month, right? Or is it $72? When I read the last earnings report from Alphabet, YouTube TV grew its subscriber count by 1.4 million people, with a total of 6.3 million active users for 2023. And I wouldn't be surprised if the subscribers doubled or even tripled by the end of 2023. So if my bullish case is correct about Google, and I wouldn't be surprised if it goes to a $2 trillion market cap by the end of 2023. And I'm also seeing a tremendous upside with Meta, Tesla, and Apple in the coming years, and which holds a big weight in the S&P 500 because they're collectively valued at almost $6 trillion in market cap. And just think of it this way: Japan's GDP is almost $5 trillion as of 2022. So how insane is that, right? But the downside is the demand for these products. If Meta comes out with a Q2 earnings report showing a slowdown in ad revenue, the stock price would take a hit in the short term. If Apple's top and bottom lines come in lower than expected, they're probably going to go back down to 2.5 or 2.6 trillion dollars in market cap. If Tesla sells fewer cars than what was projected, the share price would probably drop below $200 or $190 again, right? Could they all happen? Of course, but the chances of that happening are lower and lower, in my honest opinion. Could I be wrong? Of course. And if you look at the S fund, and I want to quickly touch on S fund. This one is the third best performing mutual fund in the TSP. And if you watch my previous video about my $1.9 million TSP investment strategy for 2023, I stated that I was going to invest 50% C fund and 50% S fund. The S fund, or the small cap and medium cap stocks, took a big downturn last year in 2022. And if this S cap starts to make a big recovery, I said I'm going to diversify to maybe 60 to 40 or 70 to 30 C and S funds. My criteria to move money out of the S fund requires the S fund to outperform the C fund. Right now, it is not doing that at 10.4%, which is still an incredible return. And I don't know what it's going to do for the remainder of 2023. We still got 6 months left, but I'm going to pay very close attention to it. But so let's say, for example, if the S fund performs a 20% return and the C fund performs 15% return, I'm most likely going to move some profit out of the S fund and move it to the C fund. Again, this is just my strategy. Just because I'm doing it, it doesn't mean that it's right for you too. And I'm in my mid 30s and my risk tolerance is high because I'm still 25 years away from reaching 59 and a half. So for every 5% gain, I'm probably going to reallocate 5% S fund back in the C fund because the C fund is less volatile than the S fund. Right now, I have 50% C fund and 50% S fund. If S fund becomes heavier than the C fund by, let's say, 5%, then I'm going to reallocate to TSP inside the TSP to 55% C fund and 45% S fund or something like that. If the S fund outperforms C fund by 10% or maybe even 15%, then I'm most likely going to reallocate my TSP back to the way it was at 80% C fund and 20% S fund. The most I'll probably do is 25% S fund because that's my risk tolerance. As I get older, going into my late 40s or 50s, I would be more comfortable with 90% C fund or 100% C fund. 90% C fund or 100% C fund. Let me know in the comment section down below what your TSP allocation strategy is currently with the bull market. But as of right now, I'm going to keep the allocation strategy the same as 50% C fund and 50% S fund because the C fund is still outperforming the S fund. And I'm truly excited to see how the S fund will perform for the rest of 2023. How the stock market performs will depend on the earnings that will come out in July for Q2 of 2023. And I think inflation will continue to go back down to the normal level at 2 or 3%, right? But regardless of what happens to our economy in the short term, I am not worried about the short term catalyst because I'm not going to touch my TSP for at least 25 years. I'm only going to reallocate my TSP between C and S funds if one fund outperforms another. Either way, I'm really excited to see how my TSP grows in 2023 and for the next 10, 15, and 20 years. All right. Am I going to buy an Apple Vision. No. Thought about it. $3,500 for the Apple goggle, or not goggle, but what are they called? The Vision AR VR. Um, no, probably not gonna buy it personally. But if I can find a way to write it off as a business expense, like if I use it for Zoom calls or talking with my clients, maybe, um, then maybe that would make sense if I get an Apple VR. But 3,500, man, I don't know who can afford that other than like the super rich. I don't know, parents with a lot of money, I guess. But um, I kind of feel like Apple's kind of slipping away. Like they should be targeting um, like college students or uh, like the millennials and Gen Zs who might be interested in doing the VR and the AR, but that price tag. I mean, I don't know. I mean, I don't know who's going to be buying that other than trying to finance a $3,500 AR VR, because you could buy a Mac Studio M2 Ultra for that same price. So that's just insane to me on the price tag. But I never buy anything first edition anyway. There's always something going on with the first product they come out, and usually they find the bugs and fix it by version 2 or version 3. So they're probably going to have AR VR version 2 in 2024 or 2025. So we'll see. But yeah. Let's see. Did I miss anything? All right. Cool. Yeah. So it's been a fun morning. If you're, still sticking with me, I appreciate you being here. I will be live streaming tomorrow at 10:45 a.m. Pacific time. So that will be a 1:45 Eastern Standard Time. So I'm going to be live streaming to find out what the Fed does with the decision to either raise interest rates or lower interest rates. So we'll see what happens with that. So anyway, I appreciate you guys being here, and I will see you